Two men, same age, same city, same $50,000 sitting in the bank, same paycheck every 2 weeks. On a Tuesday afternoon, they each make a decision they'll live with for the next 20 years. Jake buys a rental house. Marcus buys an index fund. And here's what nobody tells you. 20 years later, they end up almost exactly the same amount of money richer. Same ballpark, same net worth. You'd look at the two of them at a barbecue and never guess one took on $250,000 in debt, spent 400 Saturdays unclogging drains and screening tenants, and the other one did, quite literally, nothing. So which one was right? That's the trap. Because that's the wrong question. The right question is the one neither of them ever asked before they signed. The one that decides everything, and almost nobody runs the real math on. You've heard real estate always wins. You've heard the stock market always wins. Both camps are selling you a headline. Neither one is telling you what it actually costs in dollars, in years, in stress, in the things you can't get back. I'm going to show you the full number, the one that includes everything. Let me show you the blueprint. Let's start with the number that sells the dream. The rent check. Jake's rental brings in $1,800 a month. His mortgage is about $1,330. So the math everyone does in their head, and it's the math Jake did at his kitchen table, is simple. $1,800 minus $1,330 equals $470 a month in profit. Times 12, that's $5,640 a year, falling into his lap for owning a house. That's the number on the YouTube thumbnail. That's the number your buddy brags about at the barbecue. That's the number the real estate guru circles in red on his whiteboard. And it's fiction. Not a lie exactly, but a number that has almost nothing to do with what Jake actually keeps. Because that $470 is the number before the property becomes a real thing in the real world. Watch what happens when we let 3 years pass and add up what really left his pocket. Over 3 years, Jake collects roughly $64,800 in rent. Good. His mortgage payments total about $47,880. So far, he's up around $16,900. Feels like a winner. Now let's count what the thumbnail never shows you. Property taxes, about $3,000 a year. $9,000 over 3 years. Insurance, another $1,500 a year. $4,500. The water heater dies in year 2. $1,200. The roof springs a leak, $2,800. A tenant moves out, and the place sits empty for 1 month. $1,800 in rent he doesn't collect, plus $600 to clean and relist it. Add it up. We started with $16,900 of so-called profit, and the real costs, taxes, insurance, repairs, 1 vacancy, eat most of it alive. Jake's actual net cash flow over 3 years lands somewhere around $2,000 to $4,000, not $16,900, not the $5,640 a year he pictured, a few $1,000s, total across 3 years. And here's the part that should stop you cold. That number, that thin little $2,000 to $4,000, doesn't subtract a single hour of Jake's time. Not the 10 p.m. phone call about the broken garbage disposal, not the Saturday spent showing the unit, not the lunch break burned coordinating a plumber. If Jake paid himself even $25 an hour for the time this house demanded, his profit goes negative. This is where most people get it wrong. They confuse the rent check with income. But rent isn't income, rent is revenue. Income is what's left after the business eats. And a rental property is a business. It has overhead, payroll, emergencies, and a boss who never clocks out. The guru shows you the top line and lets you assume it's the bottom line. The gap between those two lines is where most landlords quietly lose the argument they thought they were winning. Now, I'm not telling you Jake made a mistake. Watch this, because it matters. While his cash flow is barely a trickle, something else is happening underneath. Every one of those $1,330 mortgage payments is partly paying down his loan. A slice of each payment is buying him equity, ownership, even when his checking account sees nothing. And his $250,000 house, appreciating at 3 to 4% a year, has quietly climbed to around $270,000 to $280,000. His equity, what the house is worth minus what he owes, has grown to roughly $55,000 to $65,000. That's real. That's wealth Jake built partly with the bank's money, not his own. Hold on to that because it's the single biggest thing stocks can't easily copy, and we'll come back to it. But notice the trade you just watched. The cash flow that sold him the deal turned out to be almost nothing. The wealth that's actually building is invisible, locked in the walls, and won't show up until he sells or refinances years from now. So already, on day one of the real numbers, the story flips. The thing Jake bragged about, the monthly profit, is a mirage. The thing he never mentions, slow equity, quiet appreciation, is the real engine. Meanwhile, Marcus has done nothing. Logged in once a quarter, watched a number wiggle, and we haven't even looked at what his boring choice is doing yet. You don't need more money. You need a better plan. And a better plan starts with refusing to be fooled by the biggest, friendliest number in the room. I want you to picture a different number now. Not the rent check, the repair list. Because when Jake bought that house, he bought 4 future bills he hadn't met yet. He just didn't know their names or their due dates. Let me introduce you to them because these are the costs that quietly decide whether a rental makes you money or just keeps you busy. The first one is vacancy. The average rental sits empty about 1 month a year, sometimes less, sometimes a brutal 3 months in a soft market. 1 empty month doesn't sound scary, but understand what it actually is. It's a full $1,330 mortgage payment with $0 coming in to cover it. The bank doesn't pause because your tenant left, and every turnover drags a tail of smaller costs behind it. Cleaning, a fresh coat of paint, a listing fee, your own hours spent screening the next person. Budget $0 for vacancy, and you've already lied to yourself about the deal. The second bill is maintenance. The rule of thumb across the industry is to set aside 1 to 2% of the property's value every year. On Jake's $250,000 house, that's $2,500 to $5,000 annually, every year, forever. Some years, it's a $200 faucet. Other years, it's a $7,000 air conditioning unit that quits in August, and you cannot postpone it because your tenant is sweating and threatening to break the lease. You don't get to choose the timing. The house chooses for you. The third bill is the big one, and it's the one beginners never see coming. Capital expenditures, the roof, the furnace, the water heater. These aren't if, they're when. A roof lasts 20 to 25 years. A furnace, 15 to 20. A water heater, 10 to 12. And when they don't go for $300. They go for $5,000, $10,000, $15,000 at a clip. If you own a rental for 20 years, you will replace some of these. That's not pessimism, that's a calendar. The smart landlord sets aside money every single month for a bill that hasn't arrived yet. If you're not doing that, You're not running a business. You're running on luck, and luck files for eviction eventually. The fourth cost is the one nobody at the barbecue mentions, the bad tenant. Most tenants are fine, but the one who stops paying and knows exactly how slow the eviction process is can cost you 3 to 6 months of lost rent, plus legal fees, plus repairs to whatever they damaged on the way out. One bad tenant can erase an entire year of profit, sometimes 2, and you don't get to pick when that lottery ticket comes up. Now stack these against Jake's $470 a month. Vacancy, maintenance, capex, the tenant risk. None of it appears in that cheerful little number, but all of it is real, and all of it is coming. This is where most people get it wrong. They underwrite the deal on the best month and live in the average month, and the average includes the disasters. So let's be fair and let time pass. By year 5, Jake is a seasoned landlord whether he wanted to be or not. He's on his third tenant. He replaced the roof for about $8,500. A plumbing emergency cost $1,400. One stretch of vacancy cost him a month. He bumped the rent to $1,950, which helps. But his taxes and insurance climbed too, the way they always do. After every real expense, his cash-on-cash return, the money he actually pockets against the money he sank in, is hovering somewhere around 3 to 5%. Sit with that. Not the 15 to 20% he quoted at the barbecue. 3 to 5% on the money he risked after the work he did. And here's the quiet comparison running in the background. A boring savings vehicle, a basic index fund, has historically returned around that same neighborhood or better over long stretches, with no roof, no tenant, no 2 a.m. plumbing call. Jake earned his 3 to 5% with his hands and his weekends. Marcus, if he matched it, earned his in his sleep. That's not an argument that Jake lost. He still has leverage and appreciation working underneath. We'll get to how powerful that is. It's an argument that the return and the effort are 2 separate columns, and almost nobody adds up the second one. You don't need more money. You need a better plan, and a better plan prices the disasters before they arrive, not after. Now let me turn the knife on the other guy, because if I only showed you the bruises on real estate, I'd be doing exactly what every stock market cheerleader does, selling you half the truth and calling it wisdom. Marcus looks like he's winning effortlessly. No tenants, no roof, no 2 a.m. phone call. Just a number that drifts upward while he sleeps. But the index fund has its own quiet brutality, and it's a kind most people never survive intact. The first problem is volatility, and it is not a word. It's a feeling in your stomach. In 2008, the market fell about 37% in a single year. In March 2020, it dropped roughly 34% in about a month. Picture Marcus with $150,000 in that account, watching it fall to $95,000 in a few weeks. That is not a number on a screen anymore. That is the kid's college money evaporating while the news anchors say the word collapse every 9 minutes. That is your spouse asking across the kitchen table, "Are we going to be okay?" And here's the part the index fund crowd whispers past. The math only works if you don't flinch. The historical 10% average return assumes you stayed in your seat through every one of those drops, but most people don't. The research firm Dalbar has tracked this for decades, and the finding is devastatingly consistent. The average stock investor earns meaningfully less than the market itself. Over the last 20 years, the index returned somewhere around 9.7 to 10.4% a year, but the average investor captured closer to 8.7 to 9.2%. That gap looks tiny, it is not tiny. On a serious nest egg over 20 years, that 1% slippage is the difference between $5 million and $6 million. $1 million gone. Not to fees, not to bad luck. Gone to behavior. Gone to the very human act of selling when it hurts and buying back after it's safe, which means selling low and buying high, in slow motion, again and again. This is where most people get it wrong about index funds. They think the hard part is choosing the fund. It isn't. Choosing takes an afternoon. The hard part is doing nothing for 20 years while your own nervous system screams at you to act. Marcus's edge was never intelligence. It was the almost inhuman discipline to leave it alone in 2008, in 2020, in every scary headline in between. Most people can't. That's not a character flaw, it's biology. We are wired to flee danger, and a falling portfolio reads as danger. The second hard truth, there's no cash flow. Jake gets a check on the first of every month, money he can actually spend. Marcus gets nothing he can touch. Yes, the fund pays dividends, but on a broad market fund, that's maybe 1.5 to 2% a year. On $150,000, that's around $200 a month. That's not replacing anyone's paycheck. It's not paying the mortgage. For decades, Marcus's wealth is real, but utterly untouchable without selling pieces of the goose. And the third thing Marcus gives up is the one we keep circling back to: leverage. Marcus used his $50,000 to control $50,000. Jake used his $50,000 to control a $250,000 asset. When that house rises 4%, Jake gains 4% on $250,000, not on his 50 grand. The bank's money is working for him. That 5-to-1 leverage is the single most powerful force in Jake's column, and it's why real estate has minted so many millionaires. No index fund hands an ordinary person that kind of multiplier without serious risk. So look at the real scoreboard now. Marcus has freedom, liquidity, and zero maintenance. And in exchange, he must master his own panic, accept no monthly income, and forfeit leverage. Jake has leverage, cash flow, and tax advantages. And in exchange, he takes on debt, labor, and the disasters we already counted. Neither one is the smart choice. Each is a bundle of trade-offs wearing a costume. The honest question was never, which asset wins? If you fix this, if you stop asking which one wins and start asking which set of trade-offs you can actually live with for 20 years, everything changes. Now we get to the part of real estate that the gurus love most, because it sounds like a cheat code: the taxes. And here's where I'm going to do something the influencers won't. Tell you the true version, which is more useful than the fairy tale. The fairy tale goes like this: real estate lets you grow your wealth tax-free. You deduct depreciation while the house goes up in value, and with a 103-1 exchange, you never pay taxes at all. It's seductive. It's also, in two important places, wrong. And believing the wrong version can cost you a 5-figure surprise. Let's take depreciation first, because the core idea is real and genuinely powerful. The IRS lets Jake treat his rental building as if it slowly wears out over 27.5 years, even when the market value is climbing. On the building portion of his $250,000 property, that's roughly $7,000 to $9,000 a year he gets to deduct from his taxable rental income on paper without spending a dime. In good years, that paper loss can wipe out the tax on his rental income entirely. Stock investors have nothing like it. Marcus pays tax on his dividends every year, no shelter, no deduction. So far, the fairy tale holds. Here's the half they leave out. That depreciation isn't forgiven, it's borrowed. When Jake sells, the IRS wants it back through something called depreciation recapture, taxed at a federal rate of up to 25%. If he deducted $80,000 in depreciation over the years, he could face around $20,000 in recapture tax at the sale, on top of capital gains tax on his actual profit, which runs 15 to 20% for most people, plus state tax, plus a possible 3.8% surtax on higher incomes. The deduction was real. It was also a loan from the government due at closing. Nobody puts that on the thumbnail. Now the 1031 exchange, the supposed never pay taxes button. What it actually does, it lets Jake sell one rental and roll the entire proceeds into another investment property, deferring both the capital gains and the recapture. Deferring, not erasing, and the rules are merciless. He has 45 days to formally identify the replacement property and 180 days to close. Miss one deadline by a single day, touch the money at the wrong moment, and the whole shelter collapses and the full tax bill lands at once. So, grow tax-free is really kick the tax can down the road perfectly every time under strict rules, possibly for the rest of your life. There is one way it genuinely becomes tax-free: if Jake holds until he dies. His heirs inherit at a stepped-up basis and the deferred taxes vanish. Which means the honest tagline for real estate's ultimate tax strategy is swap till you drop, then leave it to your kids. That's a real legal powerful plan. It is also a very different sentence than tax-free wealth, and the difference is the entire game. This is where most people get it wrong. They hear tax advantage and think free money, when what they're really being offered is a sophisticated timing tool, deferral, leverage, and inheritance stacked together. Used deliberately by someone who understands the rules and the eventual bill, it's one of the most powerful wealth structures available to an ordinary American. Used carelessly by someone who believed the fairy tale, it's a trap door that opens at the worst possible moment. The sale, when you've already spent the money in your head. And notice what this does to our scoreboard. Jake's tax advantages are real, but they're not free. They're a deal with future Jake. Marcus's situation is simpler and more honest. He pays as he goes, owes nothing surprising at the end, and inside a retirement account like a Roth IRA, he gets his own version of tax-free growth without a single tenant or deadline. Two completely different tax universes. One rewards complexity, patience, and dying at the right time. The other rewards simplicity and just leaving it alone. Neither is magic. Both are tools. You don't need more money, you need a better plan, and a better plan reads the fine print before it believes the headline. Let's run the clock all the way forward, 20 years. This is the moment everyone wants, the final scoreboard. And I'm going to give it to you straight, including the parts the original story got wrong. Start with Jake's house. After 20 years of 3 to 4% appreciation, that $250,000 property is worth somewhere around $450,000 to $500,000. Good. Now, his mortgage. Here's where the gurus lie, even by accident. They'll tell you the house is paid off by now. It isn't. On a 30-year loan at 7%, after 20 years of payments, Jake still owes roughly $114,000. Not zero. The loan has 30 years on it and he's only 20 in. So his real equity, value minus what he still owes, is around $335,000 to $385,000. Real, substantial, but not the free and clear castle the thumbnail promised. And that equity is trapped in the walls. To turn it into money he can spend, Jake has to either sell triggering capital gains tax, depreciation, recapture, and 6% in realtor commissions, easily $40,000 to $70,000 in friction, or borrow against it, taking on new debt. The number on the appraisal is not the number in his pocket. Never confuse the two. What about all that rent he collected for 20 years? After every real cost, the vacancies, the roofs, the furnaces, the bad tenant, the taxes that never stopped climbing, his actual cumulative profit from cash flow is maybe $40,000 to $80,000 above what he spent across 20 years. The monthly profit he bragged about at the barbecue summed over 2 decades after reality took its cut. Now Marcus, his $50,000 plus $300 a month for 20 years, $122,000 of his own money in total. At a steady 10% average, the math says he'd land somewhere near $560,000, but I won't hand you that clean number because it's a lie of a different kind. The market doesn't grow in a smooth line. It lurches. There were years his account fell 30% and he had to sit on his hands. A more honest range, accounting for real-world sequence and the fact that almost nobody captures the full average, puts Marcus somewhere around $420,000 to $500,000, and every dollar of it is liquid. He can sell a slice on a Tuesday and have cash on Thursday. No realtor, no recapture surprise, no tenant to evict first. So look at them side by side, 20 years in. Jake, roughly $335,000 to $450,000 in real net worth once you subtract selling costs, built with leverage, sweat, debt, and risk, concentrated in one house on one street in one zip code. Marcus, roughly $420,000 to $500,000, built with discipline, volatility, and total liquidity, spread across thousands of companies with 0 weekends lost. They're in the same ballpark. That's the honest answer the influencers can't sell, because they basically tie doesn't move a course or a webinar. But here's the difference that actually matters, and it's not a dollar figure. Jake worked for his. Marcus waited for his. Jake bought himself a part-time job he couldn't quit. Marcus bought himself 20 years of not thinking about it. And here's the lever that quietly breaks the tie. If Marcus had simply raised his contribution from $300 to $500 a month, an extra $200, the cost of a nicer car payment he chose not to make, compounding would push his ending balance well past $600,000. In the market, adding to your investment multiplies through compounding automatically. In real estate, investing more means buying a second house, a second mortgage, a second set of 2 a.m. phone calls, doubling the work, not just the money. This is where most people get it wrong. They obsess over which asset wins, when the real leverage was never the asset. It was the contribution rate, the holding period, and the trade-offs they could actually sustain. If you fix that, if you stop shopping for the magic asset and start engineering the system around your own life, everything changes. So far, I've been fair to both sides by exposing both sides. Now let me be fair in the other direction by telling you exactly when each one genuinely wins. Because they tie is the average. Your life is not the average. Real estate wins, clearly, mathematically, in specific identifiable situations. The first is the rent-to-price ratio. If you're in a market where the monthly rent is at least 0.8 to 1% of the purchase price, and $1,800 rent on a $200,000 house, not a $250,000 one, the cash flow math works in your favor from day one, before appreciation even shows up. Jake bought at a weaker ratio. Change that one number and his whole story improves. The second is treating it like a business, not a side hustle. screening tenants ruthlessly, budgeting for the roof before it leaks, building systems so it doesn't eat your weekends. The investors who do this earn returns that genuinely beat the market because they earned them with skill that most buyers never develop. The third is house hacking, living in one unit of a small multifamily and renting the others. Done right, your tenants cover most of your mortgage, your own housing cost drops towards zero, and you build equity with leverage on a low down payment loan. The stock market simply cannot do that. There is no index fund that also pays your rent. Before I give you the final piece, and the one that ties this whole thing together, I want to ask you for something, and I'll be honest about why. If anything I've said so far has made you stop and actually do the math on your own situation, that's the entire point of this channel. We don't do hype here. We don't sell you a guru's dream. We just run the real numbers, including the ones the industry hopes you'll never add up. If that's worth something to you, subscribe. That's it. It costs you nothing, and it tells me to keep making these. Most people who get value from a video like this never subscribe. And that's exactly why honest financial content keeps losing to the loud stuff. You can fix that with one click. Now, the final piece of the blueprint. After everything we've counted, here's the question that actually decides your outcome. And it has almost nothing to do with houses or stocks. It's this. Which kind of discipline do you actually have? Because both paths demand discipline. They just demand completely different kinds, and most people only find out which kind they lack after they've already committed. Real estate punishes the person who can't handle operational discipline. The 2 a.m. call, the reserve fund left untouched for 3 years until the furnace dies, the unglamorous grind of running a small business with one asset and one tenant. The stock market punishes the person who can't handle emotional discipline. The stomach to watch $150,000 fall to $95,000 and do absolutely nothing. Not sell, not panic, not just move it somewhere safe until things calm down. That's the real fork in the road. Not which asset has the better return. Both can get you to roughly the same place. The question is, when the hard moment comes, and it will come in both, which kind of pain can you sit through without flinching? If you're honest that you'll panic sell in a crash, real estate's illiquidity might actually save you from yourself. You can't sell a house in an afternoon of fear. If you're honest that you'll never budget for capital expenditures or chase a late-paying tenant, the index fund's do-nothing design is your friend, not your weakness. This is where most people get it wrong. They pick the asset that sounds smartest at the dinner party, then discover they're temperamentally incapable of holding it through the hard part. And that mismatch, not the asset, is what destroys their returns. The Dalbar gap we talked about? That's not a math failure. That's people holding the right asset with the wrong temperament. So before you choose what to buy, choose honestly who you are. That's the piece nobody sells you, because you can't put it on a thumbnail. And if you're wondering what happens when you stop choosing between them, when you deliberately own property and index funds together and let each one cover the other's weakness, that's a completely different equation. That's the next video in this series, and the math might genuinely change everything you think you know. There's a scene I want you to carry with you after this video ends. It's 20 years from now. 2 men, both 75, sitting on porches across town from each other on the same warm evening. The first man built nothing, not because he was lazy, because he was paralyzed. He spent 2 decades waiting to feel certain. He read the real estate forums and got scared of tenants. He read the market headlines and got scared of crashes. Every time he almost moved, a louder voice told him the other path was smarter, so he did neither. His $50,000 sat in a savings account, earning almost nothing while inflation quietly ate it. He didn't lose money in any dramatic way, he just never let it grow. And now, on the porch, the math is simple and merciless. There's no time left to compound. The cost wasn't a bad choice. The cost was no choice at all. Now the second man. He's on the other porch. And it almost doesn't matter whether he chose Jake's path or Marcus's path, because he chose one, ran the real numbers, matched it honestly to who he was, and then did the unglamorous thing. He stayed. Through the furnace that died in August, through the month the market fell 30% and the news said the word collapse. He didn't pick the perfect asset. There is no perfect asset. He picked a plan he could actually live with for 20 years, and then he lived with it. And tonight his net worth is somewhere near $500,000 that didn't exist when he started. Not because he was a genius, but because he was consistent while everyone around him was searching for a shortcut. Here's the truth this whole video has been circling. The gap between those two porches was never real estate versus stocks. Jake and Marcus ended up in the same ballpark. The real gap was between the person who ran the full numbers and committed, and the person who kept waiting for a certainty that was never coming. You don't need more money to reach the right porch. You need a better plan, one honest enough to include everything, and one you can hold on to when it gets hard. So I'm going to ask you for 3 things, and each one matters. First, subscribe, if this earned it. This channel only survives if honesty can compete with hype, and that's on you as much as me. Second, share this with 5 people. Not 50, 5. The 5 who are stuck on the porch of paralysis right now, waiting to feel sure. This might be the thing that gets them to finally run their own numbers. Third, leave a comment and tell me one thing. Are you a Jake or a Marcus? And more importantly, do you have the operational discipline or the emotional discipline? Be honest. I read these, and your answer might be exactly what the next person scrolling needs to see. The wealthy aren't the ones who found the perfect investment. They're the ones who picked a real plan and refused to flinch. You already know enough to begin. The only question left is whether you'll wait or start.